All right, let's get right into it. While everyone on Main Street is busy chasing the next AI software story, the real money is moving on a much bigger problem. You see, the physical infrastructure of AI is quite literally starting to melt, and the smart money, the institutional capital, is making huge off-exchange bets to capitalize on the one company that can fix it. We're talking about the liquid cooling squeeze in Vertiv.
I mean, the amount of money being spent here is just mind-numbing. We are talking about $5 billion every single week just from the top four hyperscalers. That's $250 billion this year alone. So, this isn't some far-off trend. It is a full-blown infrastructure arms race. But here's the problem. All that cash is smashing right into a wall.
And look, this isn't a financial wall or a supply chain problem. This is a wall of pure physics. The heat coming off these new AI chips is so intense that our old data center designs just can't handle it. You can throw all the money in the world at this, but you simply can't argue with thermodynamics.
So let's get specific on the core thesis here. We're calling it the silicon thermal wall. It's the exact point where traditional air cooling, which, maxes out around 30, maybe 40 kilowatts per rack, completely fails. It just can't cool down the next-gen AI hardware that's pushing over 100 kilowatts. This isn't just a small problem, it's a fundamental break in the system's architecture. And this is where you see this huge disconnect in the market. You've got retail traders on X and Reddit, and they're all focused on the software layer, right? The next cool language model. But then you look at the sophisticated prediction markets, places like Polymarket, and they're pricing in an 18% chance of a government-mandated halt on all new data center construction. That's a massive risk that the mainstream crowd is completely ignoring. So if these physical limits are so real, where's the smart money going? Well, they're not tweeting about it, that's for sure. They are quietly accumulating the one pure play solution to this problem, Vertiv, and they're doing it in the dark. Just look at this table. This shows you where the real action is happening, off the public stock market. Check out the key $280 level for Vertiv back in March. An incredible 85% of all the trading volume happened in dark pools. Come on, that's not your cousin buying a few shares. That is the undeniable footprint of huge funds soaking up millions of shares without tipping their hand to the public. They are building a massive position under the radar. And it's not just the dark pools. The options market is telling the exact same story. Look at the recent unusual activity. It's screaming a bullish bias. 7 of the last 10 big, unusual trades were call options, which is a super aggressive bet on the price going up. Now, sure, you see some puts down at 260 for hedging, but the overwhelming signal from these institutional option sweeps is a major bet on a breakout.
All right, but let's be real. No trade exists in a vacuum. The single biggest danger to this entire AI buildout is the macro picture. The Fed's stubborn, hawkish hold on interest rates. That's creating a serious headwind for the money that's needed to fund this whole infrastructure revolution. And here's the number that should keep you up at night, $1.2 trillion. That's the estimated debt that these AI companies are taking on to build all this stuff. Every single basis point the Fed keeps rates high makes it more expensive to pay for that debt, and that directly threatens the money needed for these projects. Now, the Fed will tell you that direct bank risk looks manageable, but the real concern here is the committed exposure. For some of the big banks, their loan commitments to AI-related sectors, we're talking semiconductors, energy, software, are already over 16% of their Tier 1 capital. That's their core safety buffer. If things go south and these AI firms can't pay their debts, that concentration of risk could spark a serious chain reaction. Okay, enough theory. Let's pull up the charts and see how this all translates into a real tradable setup. We're going to look at the key technical levels that are going to define our risk and reward on Vertiv right now. Okay, first up, the daily RSI is at 57.615. Now, what's so important about that? Well, despite the stock's massive run, it's not even technically overbought yet. That tells you there's still fuel in the tank for another move higher, which lines up perfectly with the institutional buying we've been tracking. Now, this number right here, this is the line in the sand, the 200-day moving average at $258.34. That is the ultimate bull versus bear dividing line. As long as the price stays above this level, the big picture bullish story is 100% on. But a break below it, that would be a major red flag. So we've got the physical problem, we've got the institutional flow, we've got the macro risk, and we have the technical setup. So how does this all play out? Let's game out the 3 most likely scenarios as we head into that critical earnings report on April 22nd.
In the bull case, everything goes right. The Fed is basically forced to start cutting rates. The cost of money plummets,
and that just ignites a CapEx supercycle. The hyperscalers make liquid cooling a requirement for all new builds, and Vertiv stock goes absolutely parabolic. It stops trading like an industrial company and starts trading like a critical piece of AI infrastructure.
Then you've got the bear case. Inflation just won't die. The Fed has to stay hawkish, maybe even hike again. That $1.2 trillion debt bomb goes off, and all those big CapEx plans get put on ice. And those same institutions that were buying Vertiv in the dark, they start using those same dark pools to dump their shares on unsuspecting retail buyers. The price collapses through the 200-day moving average. And then there's the black swan, the event nobody sees coming. A flagship data center, maybe from a Google or an Amazon, has a complete catastrophic thermal failure. It becomes the 3 Mile Island moment for the AI industry. Everything grinds to a halt, and the entire market is forced to reprice the insane physical risks of this build-out. It would trigger a wave of selling across everything related to AI infrastructure.
Okay, so with those potential outcomes on the table, you have to understand this. A strict risk management plan is not just a good idea, it's absolutely mandatory. Here are the non-negotiable rules for trading this setup.
Rule number 1, your stops have to be aggressive. We're using the 20-day exponential moving average as our tactical stop loss. Rule 2, as the trade moves in your favor, you have to use a trailing stop to protect those momentum profits. And rule number 3, the ultimate rule, you do not, under any circumstances, own this stock if it is trading below that 200-day moving average at 2858.34.
And with earnings coming up on April 22nd, we enforce the earnings blackout rule. No exceptions. Step 1, on April 19th, 3 days before the report, you cut your position in half, period. Step 2, you run a very tight trailing stop on the other half going into the announcement. And step 3, you don't even think about getting back in until after the market has had time to fully process the results. So, this is what it all comes down to, the one crucial question. Is the market pricing in the hard, physical limits of silicon? Or is it just chasing the feel-good hype of software? The answer to that question is probably going to define who wins and who loses in the AI space for the next couple of years.
Look, if you got real value from this institutional grade breakdown, do me a favor and like this explainer, and make sure you're subscribed to the channel.
And now I want to hear from you. Drop a comment below and let me know what ticker you want me to put under the microscope for the next deep dive audit. We'll see you in the next one.